what was the value you had to prove in order to get the leadership to support the launch of ventures?
Yeah, so we put very strong, so if I think about the framework in our mind, right? We talked about the thesis, right? Is the thesis financial or strategic?
Yep.
That's kind of the big kind of first fundamental question about what your intention is with CVC. The second one, I think we really focused a lot was the operating model.
We're going to get started for 4 minutes after the hour. Again, those the first 3 minutes are just, informal. You are going to get a breakout, so you're going to get to meet some of the other participants here. I'm going to briefly introduce our agenda and our guest. My name is Kaihan Krippendorff. I know most of you, founder of OutThinker. From strategy to venture, how to build corporate venture as strategic infrastructure. Alok Agrawal, I'll introduce him in a moment. He has been a longtime member of OutThinker. High level agenda. We just finished 3 minutes of informal networking. And then I'm going to open up, Alok and I just kind of frame the topic and pull out a few key insights from his experience. We'll do talks and insights with me interviewing him. It might not be 20 minutes, it might be 15 minutes or 10 minutes. Then we're going to put you into breakout rooms for about 7 minutes and give you a question to kind of prime the conversation. The real magic happens when you come back and we really get into Q, A, and D, D being discussion. And so we really try to, if the Q&A is like a basketball. The basketball will probably go back and forth between us and Alok. But then if we can get the basketball also passing between participants here, because we have an amazing group of innovators and strategists here, and we really value your ideas and contributions. And then 5 minutes of wrap up and key takeaways. Anyone want to change anything about the agenda? Add anything? Remove anything? Okay. Alok, he is the founder of Agrawal Capital. He invests in early stage and leading a venture syndicate of 25 limited partners. He came into the world of OutThinker when he was in the ELT of Celestica, leading corporate strategy, business development, M&A, and innovation. I could explain to you what Celestica does, but I think that it'd be better, it'd be more accurate if I ask Alok to do that a little bit later. While he was there, he founded Celestica Ventures, and he scaled the corporate venture arm to 15 million plus assets under management in the first year. He's an active member of the Open Compute Project and the Defense Entrepreneurs Forum. He's an adjunct professor of finance at Golden Gate University, teaching corporate FP&A. Sorry, FP&A, Alok, is... Can you tell us what that is, Alok? I'm sorry, I should know.
So I didn't hear the
Sorry.
question. So
Yeah.
financial planning and analysis.
Financial
So this is the
analysis.
group that basically takes all the financial reporting of the company and actually translate that to action and forecast and model. So it's a nice, kind of doing a great job with the intro. I think my brand, or where I kind of focus on, is the intersection of kind of the hard numbers of finance and the more aspirational vision based of strategy. So
Mhm.
FP&A, in some ways, I like teaching it because it almost bridges the two together.
Great. Thank you. Yes. I think that's one of the central themes that'll come out is like, financial planning analysis is about kind of creating predictability, and innovation and venturing is about creating variance and predictability and that tension. So yeah, great. Early leadership roles at Johnson Controls, Meritor, Federal Mogul. We have another former Federal Mogul person here as well, with global P&L and L and growth responsibility across Americas, Europe, and Asia, and many degrees. And in case I forget to bring this up at the end, I want you to know that our next roundtable will be February 12th, and it will be around narrative building, and how to build narratives around innovations and strategies. Excellent. Well, thank you all for being here. And thank you, Alok, for spending time with us here.
Do so.
Maybe if you don't mind, just describe to us what Celestica is, just so we can kind of know what that world was
Yeah,
in then where you built Celestica Ventures.
sure. Yeah, so first of all, thanks for everyone to take the time to be here. I know everyone has busy schedules, and I'm sure we're crossing lots of time zones, but I always appreciate these conversations. And like Kahan mentioned, I enjoy these too. I always get value out of these because everyone's got different experience at their companies and their own lives. So I just love to share stories about things that, particularly on the venture innovation space, that have gone well and not so well. So Celestica, so I would say it's a company that underwent a pretty big transformation, but I would say broadly, the industry it works in is contract manufacturing and design services. So if you work for a company that an OEM, let's say, right, a lot of the time they choose to outsource the manufacturing, and they may just simply outsource the manufacturing as a standalone piece. They may outsource the engineering along with it. They may outsource some of the supply chain management with it, et cetera. So it's kind of a menu of a value chain if you're manufacturing as an OEM product as to how much you would outsource. So Celestica is one of the large 6 players that works globally, that works on behalf of customers to build, design, and develop their products and manufacture them. And historically, they were industrially focused. So their big end markets were aerospace and defense, healthcare, semi-cap equipment. When I joined, that's where they were actually. I joined them in 2019. And they're a $5 billion company. The stock price was $7. Book value was higher than their stock market value. There's a lot of questions about what to do with the company. Wow. And I was there for about 6 years. And, Ventures was actually one of the last things I did there. But really, the goal was to transform the company, as we successfully did, from the sort of legacy electronic manufacturing services EMS player into now one of the leading suppliers of AI data center hardware in the world. So today, it's a $12 billion company. It is a $310 stock from 6 years ago. Some of that was luck. Some of that was obviously some very smart decisions we made that led to luck. But yes, I had a very fun seat, kind of seeing the company from the C-level transform from a undervalued distressed stock to almost a meme stock. So it's been fun.
No, it's really cool to watch. You see like the numbers from 5 years ago, 5 billion, 6 billion, up to 10 billion, 12 billion. And then you see margins as well. They have been like
Yes.
up, down, up, down, up, down. And then you see them start steadily climbing. And then you see investors talking about it instead of as manufacturing, starting to talk as part of the AI stack. And so you kind of reframed it across all 3 dimensions: top line, margin, and investors, whatever the category they fit.
Investor
Is pretty,
relations. I mean,
pretty
that's
amazing.
exactly right. I think it's a great conversation broadly. Like when you do a transformation like this, sometimes you just focus on one of the pieces. Like you say, okay, it's an IR conversation. Oh, it's a strategy conversation. Oh, it's an M&A conversation. And I think the mistake that's made is that it's all of them, right? Because you have to convince all different sets of stakeholders. I mean, Celestica, frankly, we had to convince our customers, we had to convince our suppliers, who obviously are important to us. We had to convince our M&A targets, like, yes, you want to be part of this. We had to convince the investors. So I think what worked well at Celestica in particular is a very small ELT. Like there's only 7 of us in the
Really?
executive in the C-suite. And in some ways, at least in that model, it was good because it made it sort of, I would say, small enough that we could work together and kind of cover all the ground very quickly. That's actually how Ventures came to be. I mean, Ventures, Celestica, I will say Ventures is something I'm very passionate about, obviously, because that's kind of what my career is now. But it took us 3 tries in Celestica to convince the C-suite to go ahead and do this because of the reputation that Ventures has. So, Lily, I think I tried this year 2 or 3 I was in the company. I tried it year 3 or 4. And then I think, in my last year, my second to last year there, we finally were able to convince the company collectively why to do this. And I think, frankly, the reason we convinced them, I think it's learning for me. I mean, maybe it should have been an obvious one. I think too much in my first 2 rounds, I focused too much on ventures is cool. Everyone should do ventures, especially if we're doing this migration towards a tech company, we should do this. What I realized is that, putting my strategy M&A hat on, I had to think about ventures in a more structured way, not just as a nice to have that sort of sits, distance from the balance sheet, distant from the business itself, but how to actually make ventures and CVC create quantifiable value for the company, which is where I think a lot of CVC struggle. And again, there's pros and cons to, I think, the way that every CVC does it. But I think the important thing at Celestica I realized is that for this to work at Celestica, it would have to edge more towards the side of how do I get value of this quickly? How do I actually monetize this? Not a theoretical, hey, in 10 years, maybe someone's using this product and it'll be cool. We had to be much more rigorous about value creation.
Tell us about the different intentions that a company might have when they decide to, and then what was the intention for Celestica?
Yeah, so that's a good question. I mean, I think, in my, as you guys get to know me, I try to keep it simple, right? Obviously, there's lots of nuances. You do all kinds of, but really there's a spectrum, basically, I would say, of financial and strategic, right? So if you want to be a pure financial CVC, your goal is to almost like the institutional VC. You are given a pot of money, and there's tons of stories you look at every day about CVC funds saying we raised another fund. which is fine. But realistically, you're not raising a fund; you're just asking corporate for money, and then you're taking that and you're managing it like an institutional VC does. So you go deploy capital as you see fit. The strategic angle of saying, well, what's the value for the company is a bit, you can stretch that. It's kind of a nice to have. The focus is to make money. So you're looking at things like IRR, you're looking at things like multiples, you're looking at exits, you're looking at that kind of thing. And you tend to have, I would say, very large, you tend to be very, very large. So companies, this is actually a very common model. You can look at Amazon, Microsoft, Cisco. They have multi-$100 million of kind of assets under management. And of course, the trade-off there, the benefit you get obviously is from a financial standpoint. If you're treating it more as an institutional VC fund, you will obviously much more likely to generate financial returns on the back end, which is great. The challenge you'll often face is a couplefold. One is that you won't integrate well with the business because you're primarily focused on financials. And two, frankly, in some ways, because the business knows that, they're less likely to work with you and less likely to feel the need to draw value from the portfolio companies. And the other way you can do it is strategically focus, kind of the other extreme. Excuse me. And you say, well, in my easy parlance, my goal is not to lose money, right? My goal is to simply not lose money, but my real goal is to generate more near-term value creation. So, for example, using the acquisition to get early access to new technology, using the investment to get access to channels I didn't have before, using the investment as a proof point to say, hey, listen, I'm working with a startup in X area. Now I can go work with established companies in that same area and say, look, I understand this space. And the trade-off there is essentially you're potentially going to lag in financial returns, obviously, because now you're focused more on, in the pot of value creation. We think about VC, the financial VCs, the range of value creation will look like this. It's going to be very low or very high. Usually it's never in the middle. I think the thing with a strategically focused one is the return profile looks very narrow, but it's just simply not as big. It's more of a safe area of returns is what I would say. And then you would say there's also hybrid. There's some people who try to do both. I would say generally that doesn't work. My 2 cents, right? Because you're pretty much going to underperform on both, right? You have to kind of pick what is your primary. And when I say primary, I don't mean it's going to be black and white. It's not like I'm only financial and strategic, but you kind of have to say whatever the ratio is, 80, 20, 70, 30. Is my primary goal here to make money for the corporation in the long term and take shareholder money and deploy it? Or is my goal primarily to create strategic value? And you would be shocked, maybe not shocked, but you'd be shocked at how wide a variance there are in answers to that question, not only amongst companies, but as I found with Celestica, even within companies.
Mm-hmm. And so for Celestica, I want to get to when does it go wrong and kind of what do we have to put in place to get right. But just
Sure.
So we can follow the Celestica story, what was the value you had to prove in order to get the leadership to support the launch of ventures?
Yeah, so we put very strong, so if I think about the framework in our mind, right? We talked about the thesis, right? Is the thesis financial or strategic?
Yeah.
That's kind of the big kind of first fundamental question about what what your intention is with CVC. The second one, I think we really focused a lot was the operating model. So who would be, and again, operating model is different from governance. Operating model in my mind is like, how does it actually run? Like who works on it, right? How's the business and the CVC team work together? How do you define value? How do you capture it? How do you measure it? And governance to me is more of a question of the deployment of money, the approval cycle. And what you'll often see is companies actually they'll skip the thesis part or not really talk in detail about it. They'll skip the operating model part or not talk in depth about it. And you're right to governance to make sure that there's just the right checks and balances.
So thesis, operating model, and governance, and often firm companies go right to governance, and then they don't really have a thesis or a strategy or consistent operating model.
This is frankly why CVC and those who follow CVC really ebbs and flows in terms of its being in fashion. Like it was super in fashion about 10 years ago. Everyone wanted one, everyone wanted to have one. And then frankly, part of the reason we started Celestica Ventures is it was at the time we started it, which was in 2024, that was when CVC was going out of fashion. So I had actually made the case that this is the best time to do CVC because frankly, we can probably do it. I think we can come in and a couple of things we can do. One is we can probably get the best CVC talent because CVC at that point was kind of it's out of fashion. And two, I felt very strongly that being in the ecosystem, that there are a lot of companies that did not, a lot of venture-backed companies said we need to do CVC differently, being from the other side of it in terms of how they were working together. And I really felt like CVC conceptually could work quite well, but we needed a new model. So it felt like a time to do something in some ways kind of disruptive, I guess I would say. So with the operating model, we focused on more strongly. I think the number one thing we implemented, right, which created a lot of other tails to it, was what I call the mission control, or the two keys model, right? And the two keys model simply said that for us to do a deal, for us to agree to take it to the IC, the governance side, and actually go get approval, I, as the head of CVC, and then whatever the business unit president is, so my peer that ran the business, we both had to agree to turn the keys to go launch the rocket. So that was very, some people, I mean, obviously I talked to a lot of other CVCs throughout my career. A lot of people said, oh my gosh, that must be hard. And I think that was the point. It's supposed to be hard. It shouldn't be that easy to get a deal through.
Mhm.
And the reason it worked was very straightforward is me and the business spread said, okay, listen, I got the financial side. It's my job to diligence it, make sure it's a good, because again, even if financial is not the main focus, you still have to not lose money. So we always would go through and do a full diligence, just like an institutional VC, around the business model, the product market fit, who's their funding, all that stuff, to just the same rigor level. And, we would also talk, we would basically come and say, yep, from a financial standpoint, we are comfortable that this is a decent investment, right? And decent being, in our mind, was, the goal generally we had was that it will create value over time. But that was not what the primary metric was. Then the business side, and again, we would work together with them, would say, okay, what exactly do we want? How can we monetize this now? What do we actually do with this today? So, for example, things we talked about before, is it a technology roadmap that we need access to? Could we develop an exclusive relationship for their technology to use in our plants? Could it provide a new sales channel, access to new customers? And the business would have to commit to numbers around that, not just say, oh yeah, theoretically they could do that. So when we actually would work together on this from the standpoint of an operating model, it was a partnership to say, how do we get the numbers to work? Because we were the ones doing the numbers, the negotiation side, figuring out, how much investment we're going to go make, what rights could we get, but we need the business to give us the input as to what they're looking for. So the CVC, the investment itself, became a shared bet between the finance side, I mean, again, strategy finance side with me, and the business side. And unless both keys turned, we would not even take to the IC, let alone try to get it approved. And of course, the downside, the thing is, it's always funny, is that the pushback I often get from the CVCs as well, you'll end up saying no to a lot of things. And I said, that's a feature, not a bug. That's exactly the point. I think that in CVC, what always shocks people or surprises people, and again, this is an eternal battle I face at Celestica, is why would a startup want to work with us? Like, if we get a deal opportunity, we better take it. And my pushback to them was, we're Celestica. We're at the time probably a $10 billion company with operations all over the world. We will have startups falling over each other to try to work with us. So us saying no to a few is not a bad thing. I mean, just in terms of numbers, like in my first year, we closed 3 deals. Yeah, first year, 3 deals. We went to the IC and failed on, I mean, again, even though 2 keys turned, the IC can still say no. I'm not saying that, but so we probably had, 3 deals went through the IC. We probably presented 6 deals to the IC. 3 of them got rejected. And there's probably about 20 deals that never got past me in the business lead. Like, one of us didn't turn our keys. And it's awkward. I mean, there's no question. No, I would say it's more awkward when I don't turn my key. When they don't turn their key, that's life of being in corporate, right? I mean, obviously the business want to do it, they want to do it. But the case where I don't turn my key and they want to turn the key, that's the danger.
Yeah.
Or that's not the danger. That's the challenging one, I would say.
Gotcha. The politically, uncomfortable one. Fascinating. I love this idea that the multiple locks and then to the IC. I have a bunch of other questions here, but I think we're going to go into breakout so we can have people ask questions. But I just want to just set us up, because I'm kind of hearing it as, okay, I got some, thesis options, option model, governance options. I got to, and communicate. And so there's a path with multiple success criteria, but it's not always success. So give us an example of when it goes wrong.
Yeah, it's a great one. I would say that, I mean, there's many of them, I would say, but I think, one story of a kind of, going wrong in the sense of creating awkwardness was, the other challenge you get to when you start a CVC, everyone's all of a sudden got a friend of the startup that they want to invest in. And so we had a case where, someone on the ELT, came to me and said, I got this buddy who's got this great startup. And, I'll describe the product in general terms. It's a product. It's an exercise product at home, basically, right? That, if you guys have seen like an ab roller, it's kind of like that, except it's got some new technology in it that's sort of innovative. And it is. I'm not saying it's not innovative, but not exactly on our strategic roadmaps to be in the health and fitness area. And so and again, good guy. I met him, whatever else, but again, no presence in our space, no alignment with our strategy. no plan how we work together. He's just like, no, we got to go invest in this guy. And, I think what went wrong really in the sense is that we had to go through and do our full diligence on this because of who was asking, right? Because it was an ELT member, an executive, one of my peers. And, even though I knew from the day one that this was just never going to make any sense, you kind of had to go through with it. And, that's what I realized, right? And this is one of our early, actually, the first one where he wanted to turn his key and I didn't want to turn my key. But, I think it was important. It was a failure in the sense that I should have said, listen, I'm going to not turn my key earlier because I think we just put a lot of cycles on it. And with the CVC team, doing diligence on a target, which we did in this target, it's not trivial. I mean, and again, these aren't big teams. I had me plus two people. We waste a lot of effort. And I am sure there's other deals that we could have moved forward that didn't go. Because again, a lot of this also is time bound, right? When companies are doing fundraising, there are close dates. This is not like hey, whenever you guys get back to us. But I do think what I've realized, right, is that the flip side of CVC we didn't talk about is CVC because the governance is different. And in some ways, some people view CVC money as easier to get, both internally and externally. You often have a very significant danger of my buddy startup kind of fallacy is what I would say, right?
Mm-hmm.
And if you don't manage that very carefully, you will end up burning all your resources on deals they'll never go anywhere. And I've seen that not just at Celestica, but at other places as well.
Yeah, no, I haven't thought about that. Yeah, the cost of the funnel can just get too heavy. All right, many questions, but what's more important is the questions of this group here. So we're gonna put you into breakout rooms. We're gonna give you 7 minutes. Introduce yourselves. I think we have rooms of what, Nazanin, 3 or 4 people or something like
Yeah.
that.
Yeah, mostly
And
3.
and
Yes.
we're gonna put Alok. He's gonna appear in some of your breakouts just to listen in. And the goal is just to come back and say, what is that big question that can feed the conversation that would be really valuable to either answer or discuss, but not have an answer for when we come back. So 7 minutes, introduce yourselves. What is the big question? Awesome. Welcome. Hopefully you guys got to meet each other and appreciate that such an interesting community of innovators and outthinkers and strategists. What I'd love you to do is type into the chat what your number one question was from your group. That doesn't mean that you have to pick one person from the group to be the official person to do the question, but out of that conversation, you had a question or your question emerged. We want to see what that is. And so that I will have on the side here, I'll have a list of questions that I'll kind of feed Alok. And then at the same time, I'm going to invite one person to raise your hand and share with Alok what your question is. Who's willing to do that? So I'm asking you to do 2 things at once. I understand that.
Maybe I can just start.
No. Yeah.
Before I can't type as fast as I can talk, I guess.
Uh-huh.
It was interesting in our quick conversation how quickly we turned to the governance, just like Alok you talked about. And so for me, it raised the question of if we are trying to advocate for innovation or move the needle for our organizations, and their organizations are so governance focused, how do we manage that? How do we get around that?
Yeah, so I think there's something we struggle with internally too. It's I don't want everyone to leave with a feeling that governance is bad or it's a problem. I think the challenge is that what companies often do with the CVC is jump too quickly to the governance question, is what I would say. So I don't think that, the way that sometimes people work around governance and CVC so maybe stepping back, when we talked about the financial sort of focus and the strategic focus, what I didn't talk about is a lot of the reason that people like the financial focus, where they have like a fund actually under management, is that you avoid governance, or you have less of a governance issue, because now you're saying, well, it's my money. I just have to go to the CFO and CEO and be done. I have to get alignment. I think I'm a very direct person. I think that's a little bit of a cop out. I just think that's sort of a trick that I think does a couple of things badly for you. One is that me having only one of the 2 keys and being forced to work with the business and forced to get approvals from my CEO and CFO. Again, I view that as a feature, not a bug. My challenge with governance, and again, some of this happened at Celestica, is what I would call the layered approvals up till then. Like I have to go through the gauntlet of like 20 people. That is where I think value gets destroyed, because frankly, when I'm talking about investing $5 million, $2 million in a company, a VC-backed company, that is an investment committee decision. I mean, there's no offense to that. I don't need a VP of finance or like a director of, I mean, this is different. This is just a different process. That is, I think, what is, from a governance standpoint, has to be understood and clarified, is that the VC approval and governance process has to exist because, again, there's fiduciary duty to public companies. There's things you have to do. The challenge, I would say, though, is that you have to do it in a way that's unique to VC, in a way that people are comfortable. So, what we did at Celestica, right, is we had said, because layered reviews is typical of most companies, we had gotten agreement to say, listen, everyone has their voice in the approach. Like early on, we developed it, like telling me, okay, I'm not going to, Treasury, tell me what you need from me, tell me, and I'm going to do all that work. So your voice will be heard in this process, in the governance model and the operating model. But I'm not going to go to you every time there's an approval, because the decision whether to invest in the company is not a Treasury decision. It's not it's not a whatever decision. So I think, to me, and the only reason that worked, in fairness, was this was a CEO level initiative, right? So to me, like, our CEO said, we have to, I want to go do this. This is important. You convinced me. So he was open to developing a governance model that made this a little bit, I would say, flatter, but not zero. Like, it's not like we could just go spend freely to avoid the governance. And again, the governance is also a feature, not a bug. I mean, the thesis, the operating model, leads you to the governance conversation. And if you're in a situation where, I would almost play back and say, if you feel like governance is stopping you from doing something that helps your innovation agenda, it almost makes you have to stop and think, is that telling me something? Like, is there something that I'm thinking about this the wrong way, that the business doesn't feel as strongly, or whatever else? Because some companies, and again, every company is different, invest in what I call corporate innovation. Like, simply, it doesn't tie to a business unit. It's just a nice thing out there. And again, nothing wrong with that. And there's a lot of companies that do that. I think, to me, though, at the companies I've worked with and seen, which tend to be more industrial manufacturing, that's a tougher sell internally, right? And frankly, some of the ones another one that failed, for example, I really pushed for us to invest in small modular nuclear reactors, which is a big thing in data center right now, right? And again, I couldn't tie exactly to a business unit, but since we're in data center, I really said we should go do this. And again, I mean, I pushed very hard. But it got rejected. And I think that the point is that governance is not a bad word. It's only a bad word if it's governance for the sake of governance. Maybe that's the way I would say it. Yeah.
That helps. Thanks.
Yeah.
Right. I'd love to invite Kevin to ask the question. I'm going to kind of set it up here because we have seen somebody talk to an innovation lead and they have no idea what CVC is doing. And CVC, has, and I guess they're supposed to be aligned to the strategy. And Barry also here has a lot of experience in running innovation programs. So Kevin has a question around the linking and when to use which.
I mean, I think that's the thing, is different operating models for innovation and growth strategy, work in different contexts. So, for me, there's this contrast between a CVC or kind of external innovation hub approach versus a more open and kind of democratized innovation operating one model where you make innovation everybody's job. How do those, different approaches, make sense in different contexts? And, to Kaihan's point, when does it make sense together, where you have a kind of this mixed operating model strategy here to drive, top line growth through innovation?
Yeah, I mean, so, at every company, I think that's part of there's also a lot of conversation as to where CVC should report. And I think it's actually very important, CVC and innovation reports to whoever runs strategy in whatever way, shape, or form that is, it should report to them. And the simple reason is CVC, M&A, innovation hubs, any of that stuff is not a strategy. Your strategy is based on a broader conversation around what the company wants to be, around markets, around where you're looking, and it's independent of all the other things. So to me, and that's, again, I think where a lot of companies have a challenge, is having an alignment on what actually are we trying to do collectively in the business. So that's number one, I would say. So to me, then the tool you would use is, say, for example, if in the strategy process we had said we want to, as we did, we want to go in data centers, like that's something we want to go do that. To me, then the toolkit comes out of saying, do I go buy a company? Do I go invest in a company? Do I set up an innovation hub? Do I crowdsource? It kind of depends on the solution you're trying to go with. I think where CVC is most powerful is in a couple things, right? Like, if you look at the spectrum, right, like almost, buying a company is kind of on one side because you're buying it, the whole thing's yours, you're doing whatever you want with it, and sort of more casual partnerships, commercial agreements, workshops, whatever's on the other side. CVC fits sort of in the middle somewhere, in the sense that you can, I always believe I'm very, old school in this way. So money has to exchange hands to create real value sometimes. And CVC is a very efficient way, I would say, to deploy relatively small amounts of money to look at multiple bets, but in such a way that the dynamic between the two companies and the fact that money is being exchanged and the fact that you can be on the board, you can actually see what the company is doing, means it puts some teeth into the relationship. So the way I always think about it, right, like open innovation, everyone's doing it. That's to me like, okay, great. Like everyone does it. And there are things you don't want to put, you want to keep it breadth versus depth. CVC in some ways to me is the next level of depth that you're saying, I'm going to write a check and actually go buy and invest in this company. And that's how we're going to tie our fates together. And the other piece I would say too is that if you're in an area where you want to be a first mover, have some exclusivity, CVC is a very effective way of doing that too. I mean, in some cases, if I find a really cool company that I think could support our roadmaps, part of the thesis was, hey, we should invest before anyone else does. So we can kind of lock them into our ecosystem, lock them into our relationship, whatever else, right? So I guess the answer I would say, it always has to start with the strategy of the company. Like, what are you trying to accomplish? And to me, I always view there's many tools in the toolkit to go enable that. I think where CVC tends to be the most effective is where you want to make some level of breadth of depths, some level of breadth of bets, but you want to have, I would say, some teeth to it in the sense that money is exchanged. That's how I would think about it.
And any follow-up question, Kevin, or is that good? Great.
No,
Excellent.
really appreciate your perspective. Thank you.
All right. I'm going to go down these questions here, but if someone wants to jump in and and articulate your question, please just raise your hand or unmute and speak. Mina, see.
Yeah, Kaihan. So we had a very similar question about how basically to align the investment opportunities with the overall strategy. But now having heard Alok's answer, I would be tempted to ask, it looks like it's a rather independent way of organizing the investment. So what then would be the reason or the rationale to actually keep both areas together?
No, so yeah, they actually so like at Celestica, for example, we would have meetings with the business to review the pipeline, right? And part of the pipeline review was aligning that, yes. So maybe backing up in our strategy, we would have, strategic initiatives, right? We would say each business has 3 or 4 kind of big things that they're going to work on, right? They're working on, whatever, growth in data center, expanding channels in Europe, whatever the case might be. So we would say in this meeting, because again, it was a 2-way conversation. The business would find companies, CVC team would find companies, we put them in the pipeline. And one of the first questions we would ask is, okay, which of these initiatives that you have does this line up to? And that was the reason it made sense to be in strategy, because they're independent in the sense that they are different work streams, but they're related, right? So stepping back even further, the reason I always think strategy teams should own strategy, intelligence, planning, M&A, innovation, venture, everything together, is because the way you enable the strategy is a toolkit. There's just different ways you can go do it. And if all you own is one of those, you're going to view that as the best tool always to go do it. Like, I mean, if I own just corp dev as an example, my view is I should always go buy a company. That's all. If I just own CVC, I'm like, oh no, I should just go invest in them. The CSO or whatever the leader of strategy is, it's their job to say, okay, the strategy is clear. Which of these people, as I look around my team in the toolkit, is the one that makes sense for this particular deal? But that upfront process of deciding the strategy is the linchpin of all of that, right? And if you choose not to do that, if you just simply say, I'm going to invest based on first principles, that's when you get into governance problems, because you have nothing to compare it to. Like, okay, we don't have a foundational document of the business strategy, so now what are you governing? Like, okay, I'll invest in anything kind of thing, right? So I think that's also maybe where teams, tend to have challenges with CVC, is that in the absence of a strategy that the CVC is aligning with, it starts to look like a distraction, like it's investing in whatever.
Mm-hmm. Great. Mine, is that good? You have a follow-up?
Yes, he does answer the questions.
Okay, great. All right, we'll go to Kevin, and then Paul, I'm going to ask you, if you don't mind, to articulate your 2 questions, if you don't mind. Kevin.
Well, so just picking up on the last response there and Mina's question, which is great. I think, for me, it's pulling on a heartstring in terms of this idea that, okay, when you think of strategy, whether we're talking about innovation, transformation, even digital transformation and so on, right? It needs to be better integrated, at least in my view. because when you create these functional silos, your priority alignment and focus as an organization is challenged. So, in that regard, I think there's a tendency where innovation is run by marketing and R&D, transformation, might be by finance, looking at cost savings and so on. IT is running digital transformation. So how do you kind of bridge, that tendency to manage strategy in these functional silos and look at it in a more kind of holistic, integrated way, especially as you're making, investment decisions, resource, commitments and so on, both human capital and financial capital?
Yeah, I mean, usually, the way, if I go back, putting back my strategy hat on, we had a pretty robust strategic planning process, right, which would do that, right? So the way we set it was like, I think every company is different, but we had said Celestica, the primary axis of the company is the business. Like it is the business runs the show, they own the P&L, and what their strategy is cascades not everybody else, to finance, to strategy, to ops, to HR. So we had a pretty robust process to say, to have a two-way dialogue with all the functions to make sure it was coherent across all of them. So for example, going back to my data center example, if we had said we want to go after more data center business with Google, picking an example, then the finance team would owe the business, tell me a financial model of how to work with Google, because they work a little bit differently than a smaller company in terms of things like payment terms, in terms of things like inventory management. So that would become part of their activity then, to make sure it's clear. If it's something around, picking one more relevant for VC, my goal is to become an automation. I'm in medical devices and I need more automation capability. Then it'd be up to the ops team to say, okay, I got to go find some automation companies or something to go look at to potentially buy or invest in. They can go support that. And the way we kept everybody honest is that we would have a quarterly review on everyone's initiatives that were all lined up at the beginning of the year and say, okay, what are you doing? What are you working on? And we'd have very rigorous conversations around, stop, continue, or change, right, is what I would say. Now, that's easier said than done, of course. It's very difficult. I'm not going to pretend it works perfectly. But I think, strategic planning, if it's just a PowerPoint exercise, a lot of companies, that's what becomes the problem. You really have to have a robust process that really forces, I would say, tough decisions around it. It's pretty imperative.
Yeah, that are actually decisions that are pre-made and not rethought later when you actually have to act on the decision. Paul, I'm going to ask you to articulate your questions if you don't mind. I'm kind of, what I like about the two questions and kind of how I pull them together, I'm almost seeing like this range from internal open innovation to CVC to M&A, and that there are gaps in it where we don't have enough funding. And so we don't have a pipeline. So
that's well articulated. Basically, I'm from the UK. We're a nanny state, obviously, as you well know. And what that means is, certainly in the region I live in, about 50% of the population works in the public sector or in the government sector. And there's a cultural challenge. So we have these organizations that know they need to innovate, they know they need to do things fundamentally differently. They know there's a level of appetite from supply chain to get involved and to do stuff. So if I take the water industry, for example, they've literally set aside, tens of millions of pounds, in 200 million pounds in the last AMP, and this AMP, it's something like £500 million for innovation, and they're distributing that out to the sort of the 15 water companies in the UK to spend on innovation. But culturally, the concept of those limited profit or very heavily regulated organizations or public services investing and acquiring a return doesn't sit very well. And of course, it makes perfect sense to bridge that gap. And we have this chasm where you've got the supply chain complaining that they go all the way through an innovation process and get to the point where it's proven, the technology is proven, it's even been out on a kind of a broader deployment and been tested in field, and everyone likes it, and then it dies because there's no money, there's no commercialization strategy, there's no one to pick up the threads, and the supply chain was just like, oh, we just thought we were expecting you to give us a big contract, and the water company or the utility is turning around saying, well, we're a water company and utility, we're not a manufacturer or a sensor developer or a data manager in that respect. So we have this problem where, where does CVC fit? How do you persuade people that CVC has a role to play and should be part of the fabric of the pipeline, if you like? And I guess that's my big question is
Yeah.
Well, it's a cultural
at
fit.
at a economic at the economy level.
Yeah, so so it's it sounds like the conversations at Celestica the first two times when I didn't get CVC through. So maybe a couple points I would make is that if I reflect on those two conversations, like that we didn't actually do CVC the first two times that I proposed it, I'm not sure the company was wrong. Like, I mean, honestly, I think at the time that where we were at, we were too conservative. We were still mid-transformation. We were concerned about the capital allocation please coming to us and saying, why are you spending $30-40 million a year on ventures? Like, we were very concerned about it. So it took the third try. So maybe the first answer I would say is CVC is not right for every company. And it's not a bad thing. Just simply there is a mindset shift that, again, I was able to push it through at Celestica, but it took 3 times of saying, to your point, for CVC has a bad reputation. What are we doing? We're in a very old school kind of manufacturing, in my case, manufacturing tech company. Why would we go do this? And the convincing took a lot of tries, right? So that's sort of one I would say. It doesn't always have to be logical. If you do feel, if you're in a leadership position of innovation, you say, wow, I really want to have something in my toolkit that I can go invest in companies and go do this. What I've often found is very effective is that find somebody from the VC world to come join is what I would say is very effective. So, I mean, even for me, right, I was getting to learn VC a little, as I went, right? Because again, I'm not a VC guy historically, M&A strategy, finance. And so we hired, somebody from Ventures, right, to actually join the team and be kind of the one that's understands the ecosystem and, is more familiar with the process to kind of be a disruptor of our thinking internally, right? And then, the other thing I would also say is that I think it's important to think about CVC as bespoke to your company, right? In the sense that I think like we talked a little bit earlier, I think you have to find a version of CVC that's right for you. So for example, if culturally people are like, man, this is a crazy idea, why are we doing this? But you feel strongly about it, you can start small, right? I mean, for example, you can do investments off the balance sheet, even if you don't, if the money there is of concern, you just say, hey, listen, we're going to do it off the balance sheet. We'll do it as needed. We're just going to invest as we see fit. Or you can simply say, hey, listen, we're going to do something that's very conservative, where there's like a clearer on the spectrum of strategically value immediately versus financial value long term. I'm going to pick something to listen. It's not a great long-term 10x investment, but something I know I can bite off and chew that'll make me some money, whatever else, and start that way. But I do think what was most effective, at least in our case, out of all of that, was having an extremely clear thesis of why we're doing this, an operating model that made people feel like they were involved and together in it. And, because our first investment, by the way, was the same way. We did it, I would say, we invested in one of our customers, which is one of the most conservative ways for us to, frankly, use CVC, because that basically guaranteed us some volumes. It gave us access to early access to things. So the value creation story was so easy in that case that it opened the doors now for us to do what I would call more traditional CVC, looking at innovation, looking at other things we could develop access. So, to me, it's always going to be a crawl, walk, run. And, but every step forward you can take is helpful. So start small, start simple, start with the business case is very clear. Even the most skeptical, internal folks can be like, okay, that'll make sense. Treat it almost like a capital investment. Like, hey, listen, call the VC fund, but I'm literally giving you a business case saying, here's exactly why this will return to us.
Great. All right. We have only 90 seconds left with you. I'm going to do a quick poll, a NPS poll, and I am going to do that now. It should only take you like 30 seconds. It's just, simple NPS. 10 is really, really great. 1 is really, really bad. And Alok, I mean, I've got so many notes and things to go with, but what would you leave us with as the final leave behind for us?
Yeah, so one thing I would say is when we did ventures, we had what we call a POR, a plan of record, that was about 30-40 pages long. And again, not supposed to be that long, but the rigor through which we thought through all these questions about what is our thesis, what is the model, what do we do differently than everybody else, what is our guardrails around investment size, stage, who owns what deal, whatever else, was extremely rigorous. So I think what I would say, the theme I would say for everybody is that there is a method to CVC. It's not to say everyone follows the method, but there is a method that's out there. So I would encourage you to think through, if you want to do CVC, I think it's a good tool in your toolkit to go through the intellectual exercise of thinking about like a project. How do I set this up in the right for my company? Not, which frankly, what I kind of did at the beginning was, hey, can I have some money now? And let's go invest in companies. So I think it's important to think very programmatically about what good CVC looks like. because unfortunately for everybody who wants to try to do CVC, the ground is littered with bad stories, but that doesn't mean your story has to be one of the bad ones.
Got it. Great. And I'm listening to this from both like the top down and the bottom up. Top down, certainly like how do you jump, but also bottom up, you're an internal innovator and you're trying to get funding for your project, and you can now understand across that range of innovation, CVC, M&A, looking at governance and structure and operating, and it gives us like an understanding of the Rubik's cube that we can unlock for getting support for our innovations. Alok, thank you so much for being with us and for sharing your wisdom and experience with us. And thank you everyone for being here. Hopefully we'll see you in February. You can reach out to us anytime. If you're not on the WhatsApp group, let us know. We'll add you to the WhatsApp group, and keep doing what you're doing, shaping the future. Have a lovely day, evening, morning, whatever that is for you. Thank you.
Thank you.
Thank you.